In economics, few things impact our lives more than interest rates, the cost of borrowing money. These rates, set by central banks like the Federal Reserve, quietly shape the world around us. They influence how much we pay for our homes, the cost of starting a business, and even the price tags on everyday goods. A single percentage point might seem small, but its effects can be enormous, rippling through every corner of the economy. Whether you're buying a house, starting a business, or managing government debt, even a tiny change in rates can ripple through the entire economy. For families, a lower rate could mean the difference between affording a dream home or settling for less. For entrepreneurs, it might open the door to new opportunities or slam it shut. And for governments, it can mean billions more or less spent on interest payments, affecting everything from schools to infrastructure. Right now, a major clash is unfolding. President Trump wants rates slashed to boost growth, while the Federal Reserve, led by Chair Jerome Powell, is holding firm. This isn't just a disagreement over numbers, it's a battle over the direction of the entire U.S. economy. Trump believes that lower rates will spark investment, create jobs, and keep America ahead in the global race. Powell and the Fed, on the other hand, worry about the risks of moving too fast, like runaway inflation or financial bubbles. The Fed's job is to balance stable prices with maximum employment, using interest rates as its main tool. Every decision is weighed carefully, with teams of economists poring over data, analyzing trends, and debating the best path forward. Their choices affect not just Wall Street but Main Street, impacting jobs, wages, and the cost of living for millions of Americans. Trump argues for immediate cuts to supercharge the economy and make America more competitive. He points to strong job numbers and a booming stock market as evidence that lower rates could push growth even higher, helping businesses expand and workers thrive. The Fed, however, is signaling caution, resisting political pressure and keeping rates steady after its July 2025 meeting. Powell emphasizes the importance of independence, warning that hasty moves could backfire, leading to higher prices or instability down the road. The central bank's careful approach is designed to protect the economy from shocks, even if it means disappointing some in Washington. This isn't just a technical debate, it's about your mortgage, your job, and the future of the American economy. The outcome will shape how much you pay for loans, whether your company can afford to hire, and how secure your savings are. Every American, whether they realize it or not, has a stake in this high-stakes decision. Let's break down what's at stake in this high-stakes economic drama, and why a single percentage point can make all the difference for millions of people across the country. To truly grasp the current standoff in the U.S. economy and politics, it's essential to understand the Federal Reserve, often simply called the Fed. This institution sits at the very heart of America's financial system, quietly shaping the economic landscape in ways that touch every American's life, whether they realize it or not. The Federal Reserve is the nation's independent central bank, established over a century ago to provide the country with a safer, more flexible, and more stable monetary and financial system. The Fed's mission is guided by what's known as the dual mandate. This means it has two main goals: first, to keep inflation low and stable, and second, to promote maximum employment so as many Americans as possible can find good jobs. Keeping inflation in check is crucial, because when prices rise too quickly, it erodes the value of your paycheck and savings. But if inflation is too low, it can signal a weak economy. At the same time, the Fed works to support job growth, aiming for an economy where people from all walks of life have opportunities to work and thrive. What sets the Fed apart is its independence. Unlike most government agencies, it's insulated from day-to-day political pressures, allowing it to make tough, data-driven decisions, even when those choices are unpopular with politicians or the public. The Fed's most important tool is the federal funds rate, the interest rate at which banks lend money to each other overnight. By raising or lowering this rate, the Fed can influence borrowing costs for everything from home mortgages and car loans to business investments and credit cards. When the Fed lowers rates, it makes borrowing cheaper, encouraging consumers to spend and businesses to invest, which can boost economic growth and create jobs. On the other hand, when the Fed raises rates, it becomes more expensive to borrow. This tends to slow down spending and investment, which can help cool off an overheating economy and bring down inflation. The Federal Reserve is overseen by a board of governors, with the chair, currently Jerome Powell, serving long, staggered terms. This structure is designed to protect the Fed's independence and ensure continuity, even as political winds shift in Washington. Powell, who was appointed by President Trump, now faces the difficult task of balancing economic data with political pressure. Presidents often want lower rates to stimulate growth, especially in election years, but the Fed's job is to look beyond short-term politics. Every decision the Fed makes sends ripples through the financial markets, affecting everything from Wall Street stock prices to Main Street mortgage rates. Millions of Americans feel the impact, whether they're buying a home, saving for retirement, or running a business. Each rate decision is a careful balancing act, trying to foster economic growth and job creation, while also guarding against runaway inflation or financial instability. That's why the Fed's independence, and its cautious, measured approach, matter so much right now. In a world of uncertainty, the Federal Reserve's steady hand is crucial for the nation's economic health and the financial well-being of every American. President Trump has launched a very public campaign demanding the Fed cut rates. He argues that current rates, over 4%, are holding back the economy's full potential. Trump wants cheaper borrowing to fuel spending, investment, and job growth. He points to other countries with lower rates, claiming the U.S. is at a disadvantage. Lower rates would also save the government billions on its debt. Trump's criticism of Fed Chair Powell is unusually direct, challenging the tradition of Fed independence. For Trump, high rates are an obstacle to prosperity, and he's determined to remove them. The pressure is on, but the Fed isn't budging, yet. Despite Trump's pressure, the Fed held rates steady after its July 2025 meeting. Chair Powell emphasized the Fed's independence and commitment to data, not politics. The main concern, inflation, which has ticked up to 2.7%, above the Fed's 2% target. Cutting rates now could worsen inflation, making everyday goods more expensive. Stronger than expected economic growth also reduced the urgency for a cut. The Fed's approach: wait for more data before acting. They're not ruling out cuts, but patience is the priority. The message: stability over speed. Trump's case for rate cuts is simple. Lower rates mean more growth. Cheaper borrowing encourages businesses to invest, expand, and hire. Consumers benefit too. Lower mortgage and loan payments free up money to spend elsewhere. Trump argues that high rates are like a tax on Americans, and a cut would be a tax break. He also says lower rates would make U.S. exports more competitive by weakening the dollar. With the government's massive debt, even a small rate cut could save billions in interest. Trump frames this as common sense: boost growth, help consumers, and ease the debt burden. He sees the Fed's caution as unnecessary and costly. For Trump, the time to act is now. He's betting that bold action will pay off. The Fed's caution isn't about opposing Trump, it's about managing risk. Inflation remains above target, and cutting rates too soon could reignite it. Recent economic data is mixed, growth is strong, unemployment is low, but inflation is stubborn. The Fed is wary of using its limited rate-cutting power before it's truly needed. It's also navigating the effects of Trump's own policies, like tariffs and immigration changes, which complicate the outlook. The Fed wants to preserve its credibility and keep its options open for a real downturn. Cutting now could leave the Fed powerless if a crisis hits. By waiting, the Fed is keeping its powder dry. Their message: caution protects the economy and your wallet. This debate isn't just for economists, it affects your wallet. A rate cut could lower your mortgage, car loan, and credit card payments, making borrowing cheaper. Home buyers might finally afford that house, businesses might expand and hire. But there's a downside: savers and retirees earn less on their savings when rates fall. Lower rates can also fuel inflation, raising the cost of groceries, gas, and utilities. The trade-off: short-term relief for borrowers, but potential pain for savers and anyone on a fixed income. If inflation rises faster than wages, everyone feels the squeeze. The Fed's job is to balance these risks. The outcome of this debate will hit home, literally and figuratively. That's why it matters to you. With the Federal Reserve choosing to hold interest rates steady for now, the financial world is on edge, waiting to see what the next few months will bring. Every move the Fed makes is under a microscope, and the stakes have rarely felt higher. The upcoming September 2025 Fed meeting is shaping up to be a pivotal moment. Investors, policymakers, and everyday Americans are all watching closely, knowing that future decisions will depend heavily on the latest economic data and trends. If inflation continues to cool and the job market shows signs of weakening, the likelihood of a rate cut increases significantly. Lower rates could provide relief for borrowers and potentially stimulate economic growth, but the risks of moving too quickly remain. On the other hand, if inflation remains stubbornly high or the labor market stays robust, the Fed may be forced to hold off on any cuts. This would signal a continued cautious approach, prioritizing price stability over short-term growth. Meanwhile, political pressure is mounting. Former President Donald Trump and his supporters are ramping up their calls for lower rates, arguing that the Fed should act to boost the economy ahead of the election. As the year progresses, these demands are only expected to intensify, adding another layer of complexity to the Fed's decision-making. Even within the Federal Reserve itself, there are signs of growing dissent. In July, 2 Trump-appointed governors broke ranks and voted in favor of a rate cut, highlighting the internal divisions and the pressure facing Chair Powell and his colleagues. The Fed is walking a delicate tightrope. If they cut rates too soon, they risk reigniting inflation and undermining the progress made so far. But if they wait too long, the economy could tip into recession, costing jobs and eroding public confidence. Investors, journalists, and the public are scrutinizing every economic report, every speech, and every hint from Fed officials, searching for clues about what might come next. The atmosphere is tense, and uncertainty is the only constant. The stakes couldn't be higher. The direction of the U.S. economy hangs in the balance, and so does the future independence of the Federal Reserve itself. Every decision now carries weight far beyond Wall Street. The next move by the Fed could redefine the relationship between the White House and the central bank for years to come, shaping not just economic policy, but the very foundation of American financial stability. America stands at a crossroads: immediate growth versus long-term stability. Trump wants bold action, cut rates, boost jobs, and make America more competitive. The Fed urges patience, focused on controlling inflation and preserving its independence. Both sides have valid points, but the risks are real. A cut could spark inflation. Waiting could slow the recovery. For Americans, the outcome will shape mortgages, savings, prices, and jobs. As the next Fed meeting approaches, the nation is watching closely. The decision will set the course for the economy and your financial future. The stakes couldn't be higher.